Welcome back to the channel, subscribers. Inheritance tax and how to reduce it. So today we'll be discussing lots of different areas in how you can reduce your inheritance tax bill in the United Kingdom. So for anyone asking, what is inheritance tax? Inheritance tax, very simply, is effectively a tax on all of your asset and estate when you die. This is a very lucrative tax for governments around the world. As you can see from the Money Helper website, this really explains the basics of inheritance tax. To give you a quick summary, every individual has £325,000, which their inheritance tax amount that they can pass onto the beneficiaries. A joint couple, that becomes £650,000. Generally speaking, there's another £175 per person to do the nil rate ban and so on. So as a couple, you're roughly looking around £1 million. If you have more than £1 million of assets as a couple in the United Kingdom, you really need to be concerned about inheritance tax. This is a far cry from our viewers in the USA will be watching this and saying that's ridiculous. In the United States, you have $12 million is the minimum assets before any federal taxes will be applied to an estate upon someone's passing. But for the majority of our users in the United Kingdom, this is going to be probably a big problem for you. Most of the people we work with are people working on final salary pension transfers. So if somebody has a 200, half a million or £1 million DB pension transfer that they're discussing with us, invariably, by the law of averages, this means they worked in a relatively professional career for a long period of time and they were on a high salary. If they're on a high salary in order to attain the large defined benefit scheme, it likely means they also have good properties. They have bank accounts, they have assets, they have ISAs, they have many other assets which would go into their estate if they were to pass away. So, what are some of the key ways in which you can look to start reducing your inheritance tax? So number one starts off with talking to a regulated and financial advisor who specializes in this area. You can book in below via the description for a free consultation with myself and one of our senior financial advisors to start understanding your situation and advising what type of advice process we may go through with you. It's very important to note in these initial calls, there's no cost, there's no commitment from your side. It really is about just understanding your situation and for you to check us out. What do we sound like? Do we know what we're talking about? Do you want to work with someone else? Do you want to work with us? And when I say work with us, I just mean go through an advice process. You can also use the link, you can use the WhatsApp link in the description section below to start a more informal conversation with myself. If you don't want to go straight into an email, if you want to have a quick chat there first, let me know. So, one of the main ways that you can reduce your inheritance tax is not the most effective, but obviously is gifting assets to your family over the course of time. There's per year you're allowed to gift a certain amount to every children, family member, etc. This is a good way of gradually getting rid of small amounts of money from your estate. It's not going to make big changes though. 2 or 3 or 5 grand here to different people doesn't really make that much of a difference. The second thing you can start looking at is trusts. Now, obviously, trusts is effectively putting your assets and putting your assets beyond your estate, and that means beyond your control. So a lot of people would say, I don't want to put my assets outside of my control. Well, that's why you have a trust. You can't legally speaking say, oh, I don't want the money to form part of my inheritance, but I still have 100% control over it. Well, it hasn't come out of your estate, you're still in control of it. That's why a trust exists. So inside the trust, you could put money there, you could put property there, you could put all types of assets there, which would then be managed by the trustee in anticipation of that money going to your beneficiaries at another point in time. Takes the money out of your estate, which means that you don't have inheritance tax to pay. It's important to know what is inheritance tax to cost. So inheritance tax is typically charged at 40% in the UK. So say you had £3 million worth of assets between you, yourself and your partner. Effectively, circa £1 million of that would be inheritance tax free. The remaining £2 million would have an inheritance tax bill of circa 40%. There'd be a few ways and tapering and stuff that you could bring it down slightly, but generally speaking, you're looking at a large amount of money. The other thing that you can use is discounted trust, a discounted trust, which obviously helps to, again, take the assets from inside your estate, put them an arm's distance from you, which again reduces your inheritance tax bill. Another thing to look at, which a lot of clients don't think about, is equity release. So, if you own a property in or anywhere near London, within a 100-mile radius of London, you're probably going to have a property which is relatively valuable. 100-mile radius is too long. 10 or 20-mile radius of London, you're probably having a property which is anywhere towards £1 million. So if you own 100% of that property, it's £1 million. If, say, you had £1 million in your bank account when you die, if it's your main residence, there's obviously allowances for that. But if you have more than one property in the UK, these assets will form part of your inheritance tax bill. So if if you did equity release on that property, you would effectively be releasing some of the equity. Maybe you could take that equity, go do something else with it. You could spend it, you could do something else, you could put it into a trust, many different things you could do with it, which would again take it out of your estate, which would reduce or should reduce your inheritance tax bill over the course of time. Many of my clients who are outside of the UK will say things such to me as, well, Dominic, I haven't been in the UK for 10, 15, 20 years, so I haven't got to worry about that. Unless you are non-domiciled and you've spent loads of time outside the UK, you fit in all the legislation, you will by default, normally, because you're a domicility, you will have UK inheritance tax to pay on sometimes your global assets as well, not just your UK assets. So that's really important for expats to understand. Start talking to us and start engaging in the conversation. I would say that inheritance tax is actually the biggest sleeping killer, so to speak, in terms of my clients and their finances. Most people who are working have done pretty well for themselves, got lots of money, but you have to watch out. Otherwise, HMRC is going to have a very large slice of your pie if and when yourself and possibly your partner pass away as well. Guys, I hope this has been a useful video on inheritance tax. Let me know if you have any questions below. And as always, please like, subscribe, and share the channel to let us know we're doing a good job. Thank you and take care with your assets.